Today, we saw one of the largest IPOs of the year when Klarna, the buy now, pay later outfit, came public, raising nearly $1.4 billion. This is the biggest deal of the biggest week for IPOs in 4 years. And it came public with a bang, shooting up 30% at the open before pulling back a bit. So I want to take a real closer look at it. I know you're interested in it. First, in basics. I call Klarna a buy now, pay later company, like Affirm Holdings, my real favorite in the group, but it's a little more complicated than that. They have all sorts of consumer financing options, including a Klarna card, as well as a technology platform that helps people track their spending. And they're already big. When you look at the top 100 merchants in each market where Klarna operates, on average, 48% of them use Klarna to facilitate payments, and 66% of them advertise on Klarna's network. The company makes money in two different ways. About 75% of the revenue comes from transactions and service fees, mostly from what they take a cut of any transaction using their network. See, when you buy something for $100 using buy now, pay later, Klarna might only pay the company $97, with the rest being a transaction fee. Then you still have to pay them $100 back, but no interest. Most of the transactions work like this. At the same time, they also get advertising revenue from merchants, and they collect some money from consumers who pay for things like their budgeting tools. Now, Klarna also does more traditional lending, with the remaining 24% of the company's revenue coming from interest income from long-term financing options, although those types of transactions are less popular now. When you look at the overall credit quality numbers, I got to say that Klarna's got impressive underwriting standards, even as the process is fully automated. Not many bad loans here. Over the past year, for example, Klarna's provision for credit losses represented 0.52 of its gross merchandise volume. That's right, 0.52. By comparison, at the commercial banks, loan losses as a share of total loans averaged 2.92% last year. So that's how Klarna operates. But what about the numbers? First, I want to note something that the company asserts in its prospectus, which is that Klarna was profitable for the 14 years of operation before choosing consciously to invest in growth to scale in 2019, entering 12 additional markets over the next 3 years and focusing in particular on growing in the United States. Klarna's been unprofitable ever since because of that decision. But management says the profitability started improving in 2023, and I think the numbers bear them out. Sure enough, over the past few years, we've seen strong growth paired with shrinking earnings losses. On the growth front, by the way, Klarna's gross merchandise volume grew 12% in 2023 and then 14% in 2024. In the first 6 months of this year, their gross merchandise volume was up 14% year over year. And in the second quarter specifically, it shot up 21%. Klarna's revenue, meanwhile, grew 20% in 2023, then grew 24% in 2024. In the first 6 months of 2025, it was up 15% before growing by 21% in the second quarter. That is a very solid acceleration. As for profitability, there are a couple key metrics here. The first is transaction margin. Klarna defines its transaction margin dollars as total revenue less total transaction costs. Pretty simple. Basically, transaction margin dollars is similar to gross profit for a normal company, and transaction margin is similar to gross margin. Klarna's transaction margin grew from 36% in 2022 to 48% in 2023, but fell to 43% last year and was 38% in both the first half and the second quarter of this year. A bit of a regression there. Don't like that. However, the other key profitability metric here, adjusted operating margin, shows a better trend. Klarna's operating margin was negative 38% in 2022, then negative 2.2% in 2023, before going to positive 6.4% last year. In the first half of this year, the operating margin came in at 2.1%. Second quarter, specifically, it was to 3.5%. Down a bit from last year, but still up very nicely from 2 or 3 years ago. That matters to me. Overall, again, I'd say Klarna has solid growth and improving profitability. That said, there are some issues with this IPO that are disconcerting to me. For example, Klarna sold 34.3 million shares. But do you know that most of those shares came from existing shareholders, not the company itself? Only 16% of those shares came from the company. In other words, the IPO is mostly about letting early investors and employees ring the register. I don't know. See, typically we don't love to see this. I'd rather see the company get the funds and invest in growth, rather than the IPO being exit liquidity for venture capitalists. But in this case, Klarna honestly doesn't need the money. They had $5.5 billion in cash and cash equivalents on the balance sheet at the end of June and excellent cash flows. Plus, there are some special circumstances here. The 20-year-old Klarna is pretty seasoned as far as startups go, and more importantly, it's been itching to go public for a long time now. We've been hearing for years now that Klarna wanted to go public, but they didn't quite make it during the last IPO wave in 20 and 21. The 2020 stocks, by the way, are really doing well. At the same time, they were investing heavily in growth, which would have made the numbers look real ugly. Then the past couple of years, the IPO market wasn't very supportive, so they kept waiting and waiting and waiting. And after getting ready to come public in the spring, Klarna pushed back its IPO further when the tariff announcements came out in April. Now it's finally happened. Throughout this period, Klarna's valuation has seesawed to the point where it gives me motion sickness. I do have Jammin upstairs. At its private market valuation 4 years ago, Klarna was valued at $46 billion. But just a year later, during the terrible year that was 2022, its valuation fell to $6.7 billion. Earlier this year, the company raised money at $15 billion valuation. Well, that's a pretty wild ride. So how does Klarna's valuation look now? Well, when the Klarna deal priced above the range of $40 per share last night, the company was being valued at just over $15 billion. With the stock opening in the 50s today, that was closer to $20 billion. After the pullback, it's now valued at over $17 billion, slightly higher than when what the venture capitalists were paying earlier this year. I gotta tell you, I kind of like Klarna at this price. I really do. Using some back of the envelope math, let me give you these numbers. I'm expecting Klarna to put up $3.23 billion in sales this year, up 15% from last year. That was its growth rate in the first half, and I'm just kind of projecting it forward. I think that's reasonable. Using that assumption, the stock's now selling for roughly 5.4 times this year's sales. Okay, remember, there's price to earnings multiple. That's on earnings. This is sales. The nice thing is that we have some good publicly traded analogs. Affirm, the best-known buy now, pay later outfit, trades at just under 7 times sales. Sezzle, which is more of a second-rate player, if you don't mind, is right around the same level at 6.9 times sales. Unlike Klarna, those two are profitable, though, but Klarna's heading in the right direction. The bottom line, while Klarna roared right out of the gate, the stock hasn't gone to an insane valuation yet. I think the numbers look good. So I think it can be bought at these levels. Even as I make no secret about it, I like competitor Affirm and its creative CEO backs leveraging for ages, and even up here, I prefer Affirm to Klarna. Mad Money is back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.